Good afternoon, ladies and gentlemen. I'm going to present on the Centaur BCI Balance Fund. Just to kind of give an introduction to Centaur. Centaur is a retail-only asset manager, so we don't have institutional funds. At the end of January, we had $6.5 billion of assets under management, and last year we grew by 40% per annum. Centaur's been going for over 21 years. We're particularly proud of our long-term track record. So both of our unit trust funds are top quartile performers in their categories over all periods, 1 year and more. And last week we won a Raging Bull Award. I think what's particularly important, thank you. What's particularly important is really our founding principles. So when Centaur was founded over 21 years ago, really three core pillars to deliver investment excellence with outstanding service and the utmost integrity. And that's really baked into our DNA. So all the staff and team live it, and it's very important for us to deliver outperformance on an ongoing basis, because that's really our core product, is outperformance, and that's how we add value to our clients. Just looking at the long-term track record, so this is 21.25 years, a net return of 19.5% per annum. So our first investors are up almost 45 times, outperforming the benchmark by 7.5%. So this really just shows you that we've delivered over a very long period, and I think it's very important that we perpetuate this performance in the future. Just our philosophy is relatively simple. We classify it as dynamic value creation, so we see a business as a value-creating, wealth-creating entity, which has to meet at least its cost of capital, and then we're also looking for undervalued situations. So simplistically, we are looking to buy undervalued growing companies. And just to show you conceptually how it works is the example on the left. If a company is creating wealth at 14% per annum, that's either by growing or delivering dividends. And we buy it at a 25% discount to fair value, and that re-rates over a 3-year period. Your 14% growth is leveraged up to 25% growth. And these are the kind of situations we're looking to unlock. And what we do this is we've got an opportunity identification template. So we're scanning the world for opportunities which are recurring themes that fill our template, and then we drill deep into those opportunities, and if they meet our hurdles, we invest in them. This whole process is built into systematic modules, so we try to create the right balance between analyst fare and process. I think this is quite important because not one size fits all. I think what's particularly important, once we've analyzed something, we feed it into our stock picking engine, which we call TopSeg. This is virtually unchanged for 20 years. And what it does is ground us during times of volatility and saying these are expectations. And for example, during the COVID crash 2 years ago, it came to the fore where there were some exceptional opportunities during times of crisis and stress. We could make very quick decisions and pounce on these opportunities. And in the recovery phase, we recovered very quickly and had very strong performance coming out of the recovery phase. We've also got some macro models and risk models. So macro models to guide us on, say, the fair value of the rand, and also conditions in equity markets, whether we should be overweight or underweight. These are basically statistically tested and generally work over a long period of time. And we've also got risk models to guide risk management. I think the whole process is a holistic process, gives us control, particularly during times of uncertainty, and we know exactly what we're doing. So we can cherry pick the best opportunities. We've got a strong basis for our decisions, and this has come through in our performance. This process is not static. We evolve to changing market conditions. I think the market's completely different to it was 20 years ago. If you don't evolve, you're not going to continue performing. Just to give you a stock that really meets all these criteria is offshore, is Dell Technologies. We see it as a high-quality company, founded by Michael Dell, one of the best businessmen of all time, from a dormant business to the third, one of the top 3 largest PC suppliers in the world. And what we like particularly is their strategy is that they are broadening their base. So they're putting more products. They've got a very strong supply chain. So there's a lot of supply shortages. They've actually got can supply the market, so they're gaining market share. And we see this is going to pay big dividends as corporates start standardizing on the Dell platform. So you can see on the right, the top graph, is their market share is continuing increasing. We think this is an ongoing trend, really, because of their strategy of broadening their product base. But we also like the broader market. We see it growing probably between 2 to 3% real, but as they take market share, they can grow the top line probably at 5 to 7% real. What was surprising about this company, it's a very high quality, long-term growth track record, but we bought it on a P of under 8 times, and its return on invested capital has actually been going up. So you can see it's over 40%. So we're finding an undervalued, growing company, high quality, and we've got 4% in the balance fund. So that's just kind of showing you we're finding an opportunity which is both undervalued and growing, and we expect 20% plus returns in dollars from Dell. We bought it at about $50, that there was a corporate action as well. It's currently around $60, so in under 6 months it's performing very well. Just some of our fundamental macro models to give you a taste. We have a purchasing power parity model on the rand, but how we look at equity returns, we look for conditions when they're favorable or not favorable. And what we've identified is during the interest rate cycle, when interest rates go up beyond a certain inflection point, the equity market doesn't perform. So we've got a tight phase when interest rates rise 1.5% off the bottom. We statistically tested this over 30 years, and during the tight phase, equities actually only deliver minus 1% return. During the loose phase, which we're currently in, equities have delivered 26% compound annual growth rate, and we can actually see this. You can see there's underlying demand for equities. So we classify conditions as positive, and we overweight equities. So that's how we employ this model in asset allocation. Just to give you a flavor, in the balance fund, we don't have enough track record because it's only been going 8 years. These models are strategic asset allocation models which work over a very long time. In the flexible fund, up to end of 2014, we were overweight equities. Then conditions were tight for an extended period of time. We're underweight equities. That's the green dotted line. And then in 2020, interest rates were radically reduced. That changed the paradigm. There's an inflection point, and we changed our equity content. Currently, we're about 85% equity content. So we've gone from about 65 to 70% equity content to 85% equity content to catch this outperformance of equities during this period. Just the asset allocation of the balance fund at this stage. Our benchmark is 64% equities. For tactical reasons, we did slightly reduce it over the last couple months, 1%. We're on benchmark. We're going to look to be at benchmark or above benchmark, but at certain times, there are tactical reasons it does deviate. In this case, there was a repurchase offer overseas, which reduced equity content. I think offshore equities seem to be playing out. So the US is going into a high interest rate cycle, which is not so positive, and we are remitting some funds back to South Africa. We think the rand is undervalued, so we do this by direct remittances or may use a currency overlay to reduce the offshore exposure. Bonds we think are good value in South Africa. We're marginally overweight and would look to increase bond exposure. We think 10% yields on the All Bond Index compared to 2% yields in the US, with inflation actually at similar levels. South Africa bonds are good value, and also the fundamentals seem to be improving for South Africa. Just some of our large equity holdings. I think what differentiates us, we've got some unusual stocks you may not see anywhere else. So Entain it's been a very good performer. It's one of the world's largest sports betting and online gaming businesses. It's listed in the UK. What's particularly exciting is it's got a very good track record and exceptional technology, possibly one of the best in the world. But they've moved into the US. The US sports betting market's just opening up on a state-by-state basis. They're the second largest. They've teamed up with MGM, doing exceptionally well. And we see as that gets critical mass, that's going to lead to value creation for Entain. We think on a sum of the parts basis, it's worth about £25. It's currently trading at about 16, but we see long-term growth from this company. Exor, also unusual. It's an Italian-listed holding company. It owns some well-known brands, particularly Ferrari. They're controlling shareholders, but they own 26% of it, amongst other companies. And this company is run by almost the Warren Buffett of Europe. His name's John Elkann. He's achieved over 20% compound growth rate in the net asset value over the last decade. But notwithstanding this, it's trading at a 43% discount to some of the parts. We think it's a good long-term holding at these levels. Aspen did very well last year. We like Stephen Sard. He's an exceptional entrepreneur, really a dynamic value creator. What he has done is reduce the debt considerably. He's invested in his manufacturing capacity. He's vertically integrated, and as this comes through, we see strong earnings growth, and we're looking for returns of over 15%. Dell, I've mentioned, we're looking for returns of 20% plus, and then Aspen's one, not Aspen, Absa we bought last year. We see positive management changes with the dislocation from Barclays, very undervalued, and a good prospect to outperform expectations. Just summing up, how has all this translated into performance? If you look over 3 years in the category, a very competitive category, there are 175 funds. We're number 6. Over 5 years, 13 out of 143, so top decile. And our target is at least 4% real returns. We're achieving that, and also consistently outperforming our benchmark. So meeting really our targets. I think our benchmark is a very competitive benchmark, but nonetheless, we have outperformed. And how can it benefit you for financial advisors? Putting the flexible fund, the balanced fund in the mix. What we have done is create 2 portfolios. So the one portfolio is the 4 largest balanced funds in South Africa, and that's the grey line. And that's achieved returns over the last 8 years of 7.7%. Then we've created an alternative portfolio, which is 5 funds, which is the 4 largest balanced funds and the Centaur BCI balanced fund. That's the brown line, and you can see that's outperformed by 0.7% per annum. So just adding a 20% holding to the Centaur balanced fund, you've managed to outperform with little added risk, and that's really adding value. We're adding incremental returns without added risk. Just summing up, that concludes my presentation. I think we're on top of our game. We've got a great team. We're very focused on performance. We've got a great track record. We're looking to perpetuate that in the future. I think we've got the tools, we've got the team, and we're very excited about the future. Thank you very much.